Auckland was supposed to be the engine room of the country. Instead, it's overheating, leaking oil and belching smoke. Housing costs are through the roof, productivity's gone missing in action, and the whole place is crawling along like a ute towing a caravan up the Kaimais. But where most people see a breakdown, savvy investors smell opportunity. To dig into the chaos and the upside, we've got ASB's chief economist, Nick Tuffley. He's next.
Financial freedom faster. Financial freedom faster.
Before we start, Mortgage HQ's snapshot has helped thousands of Kiwis stop renting, start investing, and see the game clearly. If you want the same clarity, it's waiting in the description below. Nick, let's cut straight to the chase. Is Auckland now the single biggest drag on New Zealand's economy?
Well, I think at the moment Wellington seems to be sort of winning the battle of sort of like dragging on the economy. But I think with Auckland, it's a bit of a mixed bag in the sense that, look, yes, the property market is taking a little bit of time to fire up, and I do think partly that is that shift back in migration. You know, the slowing of migration is making a bit of a difference coming through there. When we're looking at things that fundamentally Auckland drives, it's a big driver of overall consumer spending as one example. We are starting to see the overall signs of consumer spending picking up, but it's still very gradual and it's still not enough to save some of those stores that have been hanging on for some time. But just remember, in Auckland, what is it famous for? I guess lattes, Jaffas, and large mortgages. And what we've got to remember is that whilst mortgage rates have been coming down since late 2023, it's really only this year, and probably particularly in the last few months, where we're starting to see just the average mortgage rate that people are paying start to fall more noticeably. Because before that, we were all wearing our 7% mortgages, or we were rolling over onto a floating or a 6-month mortgage rate. We were picking the expensive, short-dated mortgages of the view that interest rates would come down further and we'd have a better opportunity. So that has sort of delayed a little bit just that cash flow benefit that people will be getting, and it will increasingly become apparent over the course of this year. So that is going to help Auckland turn into a little bit more of a consumer powerhouse. Having said that, look, we're expecting it to be a fairly gradual pickup in consumer spending going forward. So look, let's just bear in mind there are these lags to monetary policy. They're very important in a place like Auckland with its jumbo-sized mortgages.
So for investors at the moment, is this the perfect storm to clean up on property deals in Auckland?
Well, I think at the moment, look, it's definitely a buyer's market in many places. Auckland, you have got that stock. It's still taking a while to sell homes. Prices are just ticking along. They're sort of bouncing up and down. They've been slightly down in some of the recent months. So look, there's good opportunities out there, and the credit criteria are a lot more relaxed than what they were a few years ago. Yes, we've got the debt to income ratios that have come in, but look, the LVRs have been relaxed slightly. Those interest rate test rates are down. So that's helping make those buyer conditions much, much more favourable. Probably Wellington, if you're looking at the fact that prices have fallen a lot more, there's a lot of stock there. It's moving very slowly. Like the buying conditions there, and in terms of, is it easy for you to find what you want? It probably is a lot easier to find what you want without it being pounced on too quickly by someone else. But also, look, when you're looking ahead, Wellington, through this government cycle, there's going to be a lot of caution there in the sense of that confidence factor and the fact that employment growth is being held back by the fact you've got quite a bit of government restructuring that's probably still going to continue.
Well, how much of the problem with the economy at the moment is housing, and how much of it is infrastructure, with the government seeming to fumble it like a rugby ball?
Well, I guess the challenge is that we like to have the housing market sort of doing reasonably well, but the thing is, if it does too well, you end up in all the boom bust cycles again, and all the sort of complaints coming up about affordability start rearing its head. It is helpful if the housing market is ticking along more positive than what it is now, because it's helping feed through into consumer spending. We need more fitting out for all the new homes that are being built, for all the people who are shifting around and renewing what's there. And prices going up makes life much more comfortable for developers who may be sitting on the sideline. We do need to keep building the supply of homes in Auckland over the longer term, and developers do take a lot of financial risk in doing that. And so market conditions, which give them a lot more comfort, give them the ability to do the pre-sales that they may need to obtain their financing. That's a really important part of just helping the construction cycle avoid that boom bust cycle as well. So, but it would be helpful if housing was a bit stronger, but then we've also got to bear in mind that we've had times where if you have like a pretty pronounced housing boom, you start to get a lot of widespread inflation pressure coming off the back of that. We all suddenly go, yippee, I'm rich, and go out and start spending a lot of money of these imagined capital gains that we've got. And that further contributes to any inflation pressure that you may have coming out of the construction sector and the wider housing market as well. So, yeah. It's good to have a healthy property market, but also when it does heat up too much, then that causes its own pains. Higher interest rates, higher exchange rate, which can put pressure on exporters and push the pain onto them as well.
So with OCR rates dropping and potentially cheaper mortgage rates coming, will that help stimulate Auckland, or do we need something else?
Look, I think it will help. I think what I'd divide the sort of interest rate impact into two bits. We've got what's going to happen with just the housing market itself, because that's usually responding to where interest rates are right here, right now. It may be a little bit about where people think they will go to in the short term if they're trying to pick their timing of when they buy to perfection in their view. We've largely seen, I would say, if you're looking at, say, 2-year rates onwards, probably about, it's going to be hard, I think, for them to get much lower. We're still talking about the cash rate falling 50 points. That will pull down the floating mortgage rates a bit more, and probably the 6-month mortgage rate a little bit more as well, because that's looking at a 6-month period where the cash rate's still not probably settling at its low. So it's more that short-term mortgage rates where we can reasonably expect there to be a little bit more movement. So look, the margin that should help the housing market a bit more. It'd be fair to say that where interest rates are at the moment isn't exactly setting the world on fire, but you've still got that likelihood of some slightly further falls. And also, I think because we've got a lot of people waiting for rates to get lower, when people get to that point where they feel there's no point waiting anymore, we may get some of those people who have just been sitting on the pause button getting up and taking some action as well. So that's that side of it.
Remind me again when the next CPI announcement is, because clearly that's going to affect things.
It's sort of about mid-October, so we're a little way off. The Reserve Bank will be making its next interest rate decision before it actually sees those figures. So it'll be kind of flying blind in a sense, because that figure that comes out in October is likely to be the peak. It's likely to show that 3%, give or take, rate that's been anticipated for a number of months.
So you don't think it's going to go over 3%?
But at the moment, our forecast is around 3%. But look, you only need fuel prices to go up or down, or some tomato price impacts because there's been some random storm somewhere, and things like that can sort of nudge things around a little bit. But ballpark about 3%, and that should be the peak, and we should see it coming off quite quickly.
It's 2025, and every other country seems to be able to have inflation rates every month. When are we going to get into the digital age and get more updated inflation rate figures? Because this is nonsense at the end of the day, really.
Yeah, well, it's something that the Reserve Bank has been wishing for some time. I think the good news is that Statistics New Zealand now does have on its plan the introduction of a monthly CPI. I can't off the top of my head recall the exact date, but it will be working towards that. In the meantime, we do get, I guess, what's called the selected price indices, which is about 45% of the overall CPI basket comes out every month. It's not the whole lot. It tends to be a lot of the more volatile stuff. It's like food, fuel, international airfares and things, but there's also like the rental figures in there as well. So it's helpful in reducing a little bit of the surprise on the day when you get the quarterly number. But look, we'll get there. But one thing we'll have to remember is we get a monthly number. This being New Zealand, that monthly number will bounce around a lot more than that quarterly figure. So you've still got to try and draw a straight line, so to speak, through what you're seeing as well.
Petrol prices appear to be a little bit cheaper at the moment, certainly here in Auckland. If the CPI was at 3.5%, would that concern the Reserve Bank?
Yeah, look, it comes down to what's driving it. If it's something that's likely to be something in the short term, like let's say that all of a sudden price of oil shoots up by $30 a barrel, and we're all suddenly paying 30, 40 cents a litre more, and that drives inflation up substantially. The Reserve Bank will tend to go, okay, look, that's out of our control. It's already happened. There's no guarantee that prices will keep rising at that rate. You tend not to have that happen year in, year out forever. It tends to be like a short-term transitory thing. And the Reserve Bank tends to look through those things. So what they probably get more worried about is we go down to the petrol pump and we go, gee, petrol's a lot. Wow, inflation's just really skyrocketing these days, and it starts to affect our wider perceptions. And that can change our behaviour. And then we start, building in inflation because we change our behaviour in ways. So that's what they tend to worry about. It's just that sort of flow on impact. Okay, how do we think about inflation because we've suddenly realised petrol prices have shot up? How does it affect delivery fees? Does that feed through into the price of most goods going up because the cost of carting them around's gone up? If it's something where it's right, the labour market strengthened, wage growth has exploded, that looks like it's going to be lingering for a long period of time, that's when they tend to react to it a little bit more. So it's short-term impacts, don't worry about too much. Something persistent, tend to worry about it more.
Nick, it's always good talking to you. We always appreciate you coming on the show. Where can we see your reports on the ASB website?
Well, the best way to find them is to just go into the search bit and then type in economic insights, and that should send you to a page which will get you there. So have a dig around. We've got lots of reports there, and you can sign up to get them directly to your inbox.
Nick Tuffley, ASB Chief Economist, thank you for your time.
Pleasure.